Welcome back to Profitable Business Liquidity Solutions. We're Accrual, and in our last lesson, we established that profitability and liquidity are two different beasts. A profitable business isn't always a cash-rich business. Today, we're uncovering the main reason for this paradox, the magic and mystery of accrual accounting. Most businesses use what's called the accrual basis of accounting to determine their profit. Here's the core idea. Under accrual accounting, revenue is recorded when it's earned, and expenses are recorded when they're incurred, regardless of when the actual cash changes hands. Let's break that down with an example. Imagine you're a consultant, and you complete a client project in April. You send them an invoice for $5,000. Under accrual accounting, you recognize that $5,000 as revenue in April, and it contributes to your profit. But what if your client's payment terms are 60 days? You won't actually see that $5,000 in your bank account until June. So in April, your profit and loss statement looks good. You've made $5,000. But your cash flow statement for April won't show that $5,000 coming in. That cash arrives in June. See the mismatch? The same principle applies to expenses. If you receive a utility bill in May for services used in May, but you don't pay it until July, the expense is recorded in May, reducing May's profit. The cash outflow, however, happens in July. Now let's talk about non-cash expenses, like depreciation. This is a big one that often confuses people. When your business buys a significant asset, say a piece of machinery for $70,000, that's a huge cash outflow, right? Unless you financed it, $70,000 leaves your bank account immediately. But for profitability, you don't expense the whole $70,000 in one go. Instead, you spread that cost over the machine's useful life, let's say 7 years. So, you'd record a depreciation expense of $10,000 each year for 7 years. This $10,000 reduces your reported profit each year, but it's not an actual cash payment you're making in those years. So, accrual accounting gives a great picture of your operational performance and profitability over time. But your cash flow statement, that's where you see the real story of your money. It tracks the tangible movement of cash. Cash in from customers, cash out for expenses, investments, and financing. This timing difference between earning revenue and receiving cash, or incurring expenses and paying cash, is precisely why a profitable business can be cash poor. Your income statement might be singing a happy tune, while your bank account is whispering a worried one. The key takeaway is that accrual accounting is vital for understanding long-term profitability, but it doesn't show your immediate cash position. Always look at your cash flow statement to understand your liquidity. Let us take care of your daily accounting. Schedule a free consultation today by visiting our link in bio.